Hey everybody, good to be here today. Time for managing an options portfolio. Today I'm going to talk about three things that I think every option traders needs to know about whatever option trade, whatever type of option trade you're doing. We're going to get to that in just a minute. But before I do that, I just want to welcome everyone, whether you've been here in past sessions or if this is your first time. Glad you're here. I'm joined by Mike Fairborn in the chat, helping me out in the chat. So if you're watching live and you have questions, you can put those in the chat. Between Mike and myself, we'll try and do our best to answer your questions. Also, you can follow Mike or myself on X at Brentmore CS, at Mike Fairborn CS. We both post additional financial content throughout the week. Now, before we get to the stuff that you really came for, I also do need to mention a few important things, and that is options do carry a high level of risk and are not suitable for all investors. And multiple leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. The material today is intended for educational and informational purposes only. Paper money application, which is what we'll be using. We're using Thinkorswim desktop software today. That is provided for educational purposes as well. Schwab does not recommend the use of technical analysis as the sole means of investment research. All investing involves risk, including loss of principal. Past performance is no guarantee of future results, and probability analysis results are theoretical in nature. They're not guaranteed. So keep that in mind. Let's head on over to the Thinkorswim platform. This is the S&P 500, where roughly break even today, we'll say that. But some stocks are doing better, some stocks are doing worse. If we're planning on doing option trades, I'm going to just use as an example Microsoft here. You can see, often with an option trade, it'll start with you looking at the individual underlying stock. Microsoft has been on a tear since that last earnings that we had. It's gone up, up, up. Uh, Big green candle, green candle, green candle, green candle, down the better part of 1% today. Are we losing momentum? If you look at the RSI, which is pointing down, it's also kind of in that elevated level. Looks like we may be losing some steam here on this. So I want to use this as an example as a kind of a launching point to talk about the three things that I think that you really need to know and before any type of option trade. And for this example, I'm going to do a long put vertical, which is a bearish trade. And um, but let's talk for just a sec about those three things here. The first thing I want you to know for um, any option trade is the break-even point. Okay. What's the break-even point? That's going to tell you, because what the break-even point does is it leads to probabilities. I want you to know the probability of whatever your trade is, and the break-even point is going to lead to that. That's the first thing. The second thing, okay, I want you to know what the max gain is of the trade. In other words, the potential good stuff that could happen with the trade. And the third thing, the max loss. I want you to know the risks of the trade. I mean, this is probably true for not just trading. This is a lot of decisions in life. What are the pros? What are the cons? And what are the odds of it happening? Right? That's what we're going to do on these trades here. So let me go back here and let me get back to my chart. Here's my chart. And so let's just use an example. And for this, I'm going to start off with the Analyze tab. Now, if you're an options trader and you're using the Thinkorswim desktop, I would encourage you to be familiar and use this Analyze tab so you can see the risk profile. I'm going to go to Add Simulated Trades. I'm just going to go out, we'll go out 16 days here on this. And the stock right now is about 490, so a little more expensive of a stock here. And I want to kind of compare a couple different long put verticals. I'm going to look at a 500 490 long put vertical, and I'm going to compare that to a 490 480 long put vertical. Let me click on risk profile now. Okay. And let me just go and let's start with the 500 490 long put vertical. That's what it looks like right there. You can see this. And there we go. Let's start with the break-even point. I can look at the break-even point. I can simply click on this little three-line menu, and I'm going to set slices to break-even. My break-even point, roughly $494. Okay. So I'm going to just start off break-even $494. What's my probabilities? Well, the probabilities depend on the break-even, right? The probabilities of it being profitable, that would be this side of the break-even point, roughly 56%. Okay. And again, these are just kind of estimates, theoretical in nature. Probability of being worse than break-even, about 44%. So I'm going to say 56, 44, and there you go. Now, obviously, if I slide this over, if we change the break-even point, the odds of it being here are less. Right now, it's most likely, this is what we call a higher probability trade. Why is it a higher probability trade? Because of the strikes we picked. All right. Now, let's talk about max gain and max loss here, because that's a key factor as well. What's my max loss on the trade? Max loss is $350 on the trade. Okay. Now, it's changing a little. Hold on one second. It's changing just a little bit because the price is fluctuating a little bit. So max loss, I'm going to say 355. 355 is the max loss. And, excuse me, max gain, that 355. Max loss, about 645. Minus 645. So I stand to lose more than I stand to gain on the trade. You need to know how much you lose, how much you gain, and maybe those in relationship to one another. And that may determine the trade. Because this is a higher probability trade, we are standing to lose more than we stand to gain. That's typical, by the way. Let's change this and look at our other possible strikes here on this. When I shift to the 490, 480, a little bit out of the money on these, and I look at my break-even point, set my slices to my break-even point, my break-even point is now 485. In other words, I need the stock to go down further. Stock's around 490 right now. We needed to go down to 485. So our probabilities went down. Our probabilities of losing on this are about 54%. Okay. Our probabilities of winning are about 46%. So in other words, we shifted from 56 winning to 46 winning. And we shifted from 44% losing to 54% losing. But there's a consequence to that. And that is, now if we look at our max gain, 510, our max loss, 490. Slightly better, looking a little bit better in that front. So no matter what type of trade you're looking at, you need to know those three items: break even, max gain, max loss, in terms of deciding whether that's a trade you want to do. Okay. So let me go, and I'm just going to actually place that trade here just to demonstrate it. Let me go and click on single. And if we wanted to actually place the trade, and I'm going to do the slightly higher probability version of that trade. So I'm going to do the 500, 490. I'm going to buy the 500. Just click on the ask price. I'm going to go to the 490. I'm going to sell that one. I'm going to hold down my control key before I click on the bid price though. If I don't hold down the control key, I'm just going to replace the 500 with the 400, 490. I want them both there. That is a long put vertical spread. I can click on confirm and send. I can then review the order. I can see my max profit, max loss, and you can see the numbers have shifted just a little bit there. My break even, strike price, stock price. And then if it's something I like, what I can do is I can just put that in my long verticals bucket there and send that order there. Okay. So we'll see if that fills. It filled right there. So what about other types of trades? Well, let's look at a different stock. Okay. I'm going to go to USB. USB. Here's USB. Using my technical analysis, basic technical analysis, we're going to say the trend is going up. This is a 20-day moving average, by the way. This is a 50-day moving average in blue. We're above those. We seem to be bouncing. We seem to be going up. So I'm going to call this a long call. We're going to just look for something in a long call. What's my max gain? What's my max loss on this? If I do a long call and I go to the Analyze tab, I'm going to USB. Let me get rid of that. And I go to USB. I go to Add Simulated Trades. I'm just going to go at the money. I'll go out a little farther in time. Let's go out 44 days. And I'm just going to go stocks around a little shy of 65. So I'm going to click on 65 long call. I'm going to click on that. And then if I if I go to the risk profile, what happens is you end up on a long call. If I scroll over, the more the stock goes up, the higher it becomes. Okay. And so I have theoretically unlimited risk on that. Unlimited reward on that. My risk is 193 bucks, the amount of the trade. Well, that's a good deal, right? Max gain, unlimited theoretically, max loss 193 bucks. That's a good thing. What's my probability? I'm going to have it's going to be a negative probability trade or low probability trade, less than 50% chance of winning. That's true for any long call you do, any long put you do, they're going to be a low probability trade. Now, I can quantify that if I want. I can set my slices to break even. Let me just change my dates here. Set slices, break even. If I want to quantify that, and I have something wrong here, 9/19, September 19th. Why are my slices not setting here? 8/4, well, for whatever reason, it's not giving me a slice where it should be, but we'll put it approximately right there. About 68% chance we lose on that. Now, furthermore, one reason is that time decay is working against us. Okay, this is a negative theta trade. So when we do the calculation of max gain, max loss, looks great, but there's a price to it. And so this is maybe a little bit more speculative in terms of if I really think this is going to move up a lot, it may be worth it because even though the probabilities are a little less, significantly less, okay, significantly less, if it does turn in my favor, it potentially could make me a lot more money. Okay. So other types of trades as well, we could look at. Let me do another one, totally different type of trade. And we have different encounters here with this. This is more of a neutral. I'm going to say this, we've been kind of going more neutral on Starbucks. If I go to Analyze on Starbucks, go to Add Simulated Trade, and let's do like a calendar spread on this. Okay. So I'm going to do a calendar spread. I'm going to sell a near term. We'll go pretty much at the money. And we'll go 106, sell the 106. We'll go out 23 days. I'm going to go buy the 123. Okay. So we're going to look at this. This is not a trade I would probably do because of the bid-ask spread there. And let's go to risk profile. Now, let me just kind of shrink this down here. Let me address a question. Lynette, good question. Would you want to buy longer term to reduce the theta risk on? So that's a very good question. When we were looking at USB, it's a long call. Time decay works against us. The longer you buy out, the longer duration, I think I bought like, what was it, 44 days or something like that. The longer term you buy, the lower the time decay will factor into it. Well, let me restate that. The lower the daily rate of time decay on that trade. However, if you hold it longer, eventually the time decay will, ramp up. So I would say, yes, that would benefit us to hold it longer, to buy the longer dated contract to get the lower daily rate of time decay. But if you're planning on holding the trade, for a shorter period of time, it's also going to cost less. So ultimately, there's a little less risk in the trade as well on that. So there's other factors into that, but everything else being equal, you're correct. The time decay is the rate of time decay is a little lower if you go longer. And so that's typically why we're looking at 50 or more days on these long calls or long puts, versus when we're selling an option, often we'll look 30 days or less when we're selling an option on those. So good point you bring up, and just factor in all the considerations there, including the max loss you're going to take on that trade to help you come up with the final decision on this. Now, I have a calendar spread here. And one thing I want to point on the calendar spread is this. Let me just move this over so you can see it a little bit better. Okay. Here's a calendar spread. If I look at the trade that I have right now, and I look at the max gain, it's right around here, right around $70 or so. Okay. Right around $70. But one other factor when we're considering this max gain, max loss, and break even is, what are the odds of the max gain being hit? Like, this comes to a very specific little point. That is the max gain. Okay, that's the max gain. But I think it's a little bit it doesn't really represent the trade very well to say that's the max. I mean, it truly is the max gain, but the problem is the odds of hitting that max gain are pretty slim, right? That you're trying to hit the bullseye right there. It's much more likely, if we are going to have a gain, that it's going to be a little bit off that max gain there. So I think that's something you need to take into consideration as you do this. Now, you can still do your analysis of your probabilities on this trade, if you like, and your max gain and your max loss. And, sometimes when you look at all these things together, it may not be a trade you do. Like, let's think about this together. There's a 21% chance, approximately, these are just kind of theoretical in 21% chance of break even or better, okay, of being positive on this. My max gain is, well, it's the distance between this and this, okay. My max loss is actually significantly bigger on this. True, we do have positive time decay. Theta is positive in this area here, positive theta. If it does go out here, time decay actually works against us, or down low enough, time to go against us. So you got to weigh all these factors together, but you don't know them unless you figure out your break-even points. Here's your break-even points, 21% chance. Your max gain, your max loss, and your max loss on this is going to be the initial cost of the trade. So about little over $200 on that is the max loss, much higher than what our potential max gain is there on that. So factoring all those things together, would you do that trade? Well, I'm not going to tell you right or wrong, but I would say putting those in together, I don't think they would meet the parameters that we normally use in this webcast. Let's do one more, then I want to go to managing existing positions in our portfolio. I'm going to bring up PayPal, PYPL. PayPal, it's run up pretty significantly. I'm going to consider this more of a bullish trade because the trend is up. We potentially have some support, probably about in that area, I would say, and some more support down here perhaps. And so I'm going to call this a bullish trade, and I want to look at that short put. I'm going to look at a short put on this. So let's do a short put on PayPal. I'm going to go here, and let's just go out, I'll go out a month, okay, 30 days on this. And I'm going to go to a short put, and I'm going to we'll go to 37 delta. Ooh, the spreads are terrible on this. Let me go to a monthly contract. Let's go up 44 days. Okay, yeah, this is going to be much tighter bid-ask spreads when we go to the monthly contracts versus the weekly contracts. So that's what I'm going to look at here. Let me go the probability of this. I'm going to go to, here's my probability of it being out of the money. We can go to about a 68% chance of it being out of the money. I'm going to click on this, and we're going to look at our trade. And if you look at, we may have a positive break even on this. Let me just go to September here, set slices, break even. Okay. So odds of the trade. Our break even point is 53.80. Odds of positive trade are $73. Odds of a negative trade are, not 73%. Odds of a negative trade are about 26%. So higher probability trade, what's my max loss? Well, my max loss on this is huge, right? It's basically the price to buy 100 shares of this, because that's what I'm agreeing to do if I sell a put. Buy 100 shares of this at $55 a share. That's $5,500 less our initial credit. So if your max gain on this is 120 bucks, okay, I'm just going to round here a little bit, $120 max gain. My max loss, we said, was 5,500 minus the 120, so we'll say 5,400 max gain, max loss. Would anybody ever do this trade? The answer is yes. Sometimes people do the trade. And let me give you an example. It's not a recommendation on this, but let's say you are, have you ever watched one of those commercials on TV for a medication, and it sounds like half the commercial is just disclaimers about possible complications from it? I get some eczema sometimes. It's a minor irritation, and I do this. And if you look at the potential risks, sometimes on these commercials, it'll talk about like death as a possible risk. Well, look, I'm really willing to put up with some issues, but death, right? But I still may consider a trade, still may consider using a medication, right? Because the odds of the adverse reaction may be so low that you weigh it and you may say it's within reason. Now, this isn't medical advice on any individual medication or anything like this. All I am saying is this. If I look at this and I say, my max loss is $5,400 and my max gain is $120, then just from that, yeah, and I have a 73% chance of a gain and a loss, you may never do the trade if that were just the only consideration. So I think when you consider max gain and max loss, you have to consider, yes, what the max gain and max loss are, but you also have to consider what the likelihood of a max loss is or a max gain is. And what's the more likely loss scenario versus or the more likely gain scenario when you factor that in. So I said there's three things you need to consider: break even, max gain, max loss. Let me just add in a more likely loss scenario and a more likely gain scenario in your calculation as you're doing that, okay? So please just make sure you consider all those factors as you're doing that trade. I'm going to just right click on this. I'm going to confirm and send that trade, and I'm going to send that trade here. So I'm going to put this in our short puts category there, put that in there. Okay, now let's go here. Let's go to, let me just double check chats. HV is historical volatility. IV is implied volatilities there on this. And just, I don't want to get too off the rails here, but there's some chats about that. Remember, implied volatility is forward-looking. Historical volatility is backward-looking as you're looking at those. Now, let's look at some trades. And these are actually kind of follow-up trades to what I did in last Friday's Advanced Options webcast. If you are interested, each Friday, I hold a webcast on advanced option strategies. I just put a playlist in the chat for the Advanced Option Strategies webcast. Okay? And last Friday, we talked about straddles. Okay? And I just put them down here in the unallocated. And we did a couple different straddles in last Friday's webcast. And a straddle, for those of you who aren't aware, is just a long straddle is a trade trying to take advantage of a big move. Well, one of those was on Palantir. And we did it specifically on earnings, the expectation of a big move on earnings. Well, we had a big move on earnings, right? And so we had an automatic exit based on time. I was actually out of the office yesterday, not looking at anything, and so it exited us. Great. So that actually seemed to be okay. If I go to PLTR and look at our trade, we had a straddle on it, okay? We entered this was on Friday, and we entered at a $14 debit, and it turned out great. It happened to have a big move. It's not to say that this trade's always going to work out well. It could have easily just not moved that much, and we would have lost money on it. But in that case, it actually worked out pretty well. We did that straddle based on earnings. We did another, and so we had put in the automatic exit. So there's no managing that at this point. But here's another straddle we did on FedEx that isn't based on earnings. This is just based on the expectation that it's been lower volatility. We're expecting a higher volatility on FedEx. Well, have we seen that? No, we haven't. You can tell that from our PL Open. We're losing some money on this. So the question is this: the question is, what do we do with this? Do we stick with this? Well, consider the original intent of the trade, right? Now, we knew going into this, this is a lower probability trade. Long straddles is just a long call and a long put, and you put them together, and the long call is a lower probability trade. The long put's a lower probability trade, but it's just a expectation of a bigger move. We haven't seen that. Is there still a potential move on this? Yeah, there's still a potential move. Let's look at the chart here. Let me get out of my drawing tool. Go here. That's not the stock we're looking at. We're looking at FDX now. And you can see it's just kind of been going side, maybe down a little bit, but well, since Friday, I don't know, roughly sideways, I guess, since Friday. It's not really moving. My intention, though, was to wait for it to move and give it some more time. Now, if this indeed started trending strongly, what we may do is we may say, hey, I'm just going to go with the long call component of this and get rid of the long put. It would be at a loss at that point, or vice versa if we started trending down. Right now, there's no clear direction. Our intention was to wait on this. We still have 16 days, and therefore, I'm just going to let it sit. We'll look at this again probably next week in this webcast and wait for that to, see what happens on that. Let's look at some other types of trades. Remember, it's important to know what the intention of the trade is when you get in the trade. These are mostly stock trades, and this is a managing options portfolio class, so I'm going to stick with options trades. CSX, I have what? I have a long call and a short put, same strike, same expiration. That's a long synthetic trade. That is meant to kind of simulate, if you will, just buying stock, okay? It's not buying stock. One reason it's not buying, one difference is this expires in 16 days. It expires. So we can't treat it exactly the same as stock. That's one reason. Another key kind of difference is if the stock does pay a dividend, you don't receive dividends if you do a long synthetic trade. But for the most part, we're going to manage this like we would an individual trade, a stock trade, okay? And so this is a bullish trade. As long as we're bullish on this, we may want to stick with this trade. But with the expiration coming, we may need to do something with this, okay? If we're not bullish or we think the run has taken its course, we may just exit the trade. Well, let's look at the chart on CSX. CSX. Still bullish? I'm going to call this still bullish. Now, it's not a guarantee. I don't know what it's going to do, but I'm going to call that a support level. Okay? I'm going to call that a support level, and I'm going to call this generally an upward trend. All right? So with that management in place, I may look to roll this out to a further date. Okay. Now, one thing, if you were just doing a long call, let's say we were just doing a long call, something we mentioned earlier is theta, time decay. As we mentioned, time decay really ramps up as you get closer to expiration. If it were just a long call, that would definitely be a consideration to do something with this that would, motivate us to move even quicker. In this case, I don't just have a long call, though I also have a short put. I have something with negative theta. I also have something with positive theta. Do they totally cancel each other out? Not in this case. They're not totally canceling each other out. We still have a little bit of negative theta, but it's less of a pressing issue in this case. Okay? it's less of a pressing issue in this case because we've reduced the theta because it is this long synthetic. All right. So I'm actually going to look to roll this out. We could wait till next week on this, but I'm going to look to roll this out with the intention that this is going to be a longer term bullish trade. So I'm going to look to exit out of this trade and do something at a later date. So how would I do that? First of all, I'm going to look here, and I'm going to look at the date that I want to do this to. So our current position is right here. I'm going to go out a little bit long. I'm going to go out to November on this. So it's a long synthetic. So I'm going to go to November. I'm going to just check out my strikes. We got 50 or 52.50. The stock's close to 51, so we're almost mid-range. I'll go to the 50. I'll go to the 50. It's going to cost us a little because the calls are going to cost a little bit more than the puts. But it's not going to cost us that much because they offset each other to a certain extent. We're going to buy the call. We're going to sell the put. I need to get out of this existing trade, though, here on this. I can highlight this, I can right-click on it, and I can create a rolling order. And I'm going to do, I'm going to do this, and it's not liking that. So here's what I'm going to do. I'm just going to get out of this trade, actually. So just keep in mind, if you do roll a trade, it doesn't save you on commissions. You still pay the commission on rolling the trade. But I'm just going to actually get out of this one. And I'm going to buy the new long synthetic. We're going to take a little profit here on this. This trade actually worked out fairly well. We're going to create this closing order, and I'm going to confirm and send, and I'm going to send those. Now what I'm going to do is I'm going to go to my trade. We said we were going to do the $50. I'm going to buy the call. I'm going to hold down my control key. I'm going to sell the put. Same expiration date, same strike, buy the call, sell the put. That is a long synthetic. And we're just going to go here. And I'm going to put this in my long stock synthetics group for the bullish trade. And we rolled that out, not using the roll function, but just closing out of the one and entering the other one. Okay? So we can do that. Okay. So there we go. And now we have a longer expiration date. The theta on this, slightly negative, not much, again, but it does by rolling to the longer date, that actually reduces the theta too on that. Okay, there's CSX. Let's move on. We did a trade. We did a protective put on earnings. Okay, we did a protective put on earnings on Kraft. And here's what KHC did. It didn't do well. The plan is to hold on to this stock longer term, which is why we did the protective put. If we didn't want to hold on to it longer term, we would have just probably exited the trade. Well, in this case, we just put on the protective put, and it kind of did its job, right? Earnings came out this morning. We lost $185 on the stock today. We gained $180 on the puts. So there we go. But I'm going to get rid of this. The puts are going to have a negative time decay. They're also going to go down in value as implied volatilities drop. And even though implied volatilities have probably dropped most of the way they're going to drop after earnings, a lot of times there's a little bit of a lingering higher implied volatilities that will continue to bleed out of that as we get further from earnings. So I'm just going to get out of this trade. We're going to call that a win here in terms of protection, even though we didn't make any money really. We just helped offset the loss. I'm going to close this out, confirm and send, and get out of that. And that one actually worked out fairly well. Okay. So, question from MBH. Can I comment on the commissions and reward to risk profile as a percent of a butterfly? Let me generalize that and not just talk about butterflies, but let me also talk about like butterflies and iron condors here, because it's a good question. Because we're talking about reward, risk and reward, max gain, max loss, and whatnot. Remember, multiple leg option strategies. Okay. With a butterfly, you have 4 legs. Okay. With an iron condor, you have 4 legs. All right. There's other trades that we could talk about that have the same thing, but let's just kind of talk about that. Often, butterflies, even more so iron condors, you end up like with an iron condor with a really small credit. Okay. And the commissions can take we'll say a disproportionately large part of that trade. Same thing with a butterfly. It's going to be a debit spread. Okay. It's going to cost you something, but commissions can really eat into this. So the point being is this, and good question from MBH is how big a consideration is that? Because I said 3 considerations kind of headlining this webcast: break even, max gain, max loss. Maybe if there's a 4th, kind of a shadow 4th, so to speak, commissions. How much are commissions going to take of the trade? Not only the initial commission cost, but commissions as compared to what your max gain and your max loss is. That decision drives a lot of people to say, you know what, I'm not really going to do, say, an iron condor, okay, or a butterfly or something like that. So think about it. Good question. I can't make that decision for you. Very often in this webcast, we will look at butterflies. We do butterfly spreads. Often they're unbalanced butterflies. We'll look at iron condors, but it is a factor. Okay, let's move forward. I think we probably have time for maybe one more here on this. Okay. Let's go, and I'm going to do one. Actually, let me just kind of quickly show you some, and then I want to trade a different one because I don't have time to trade everything here. Calendars. On calendars, we may consider rolling or consider rolling. This AVGO is an interesting example, actually, because it's a stock that actually just moved significantly against us. AVGO. We had a calendar spread, more of a neutral trade. We kind of were expecting this channel. It actually broke out of it. Fortunately, we've benefited enough from time decay that we're positive right now. So that's that's just an example. Calendars often are slow moving trades when they go in your favor, but they also are slower to hurt you when they go against you as well. Just on as a generalization on that. Bank of America, I've got 2 days to go on this. I either need to roll this. This is a diagonal spread. I either need to roll this or just close it out. Okay? I just need to roll it or close it out. mRNA, we have a butterfly spread. 2 days to go. We're just going to get out of this trade. I'll probably do that after the webcast here today, just for time's sake. But this would be one we'd get out of. There's only 2 days to go on this trade there. So there we go. And final thing to look at that I'm going to probably have to do off after the webcast is on Schlumberger, long right here. Here's the note. Someone mentioned the notes column before. This is our poor man's covered call we've done in the past in this webcast. And well, we still have the long call. We don't have a short call currently. I'm going to look to add a short call onto this trade as well to try and bring in some premium. And as we do that, it can help reduce the overall kind of net cost of the trade there. This trade's not going so hot right now. Hopefully the short call would benefit us on that. All right, there we go, everybody. So I'll do a couple trades, exit a couple, and enter one probably after this webcast, but I'm out of time. Hey, you're watching the Trader Talks channel. If you liked this webcast, would you click the thumbs up at the bottom of the page? It does me a favor. It does free education a favor. It helps the algorithm here for us. We appreciate you. We appreciate your attendance, your viewership. I invite you back next week in this webcast. I have in the description of this webcast both the playlist for the advanced option webcast and this webcast as well. But subscribe to Trader Talks so you can see future webcasts that are of interest to you. Thanks, Mike, for helping me out in the chat. Appreciate you all, and we'll see you same time next week. Bye-bye, everybody.